To compare the current financial crisis with the 1930s is a little bit naive, because in the 1930s you didn't have hundreds of trillions of dollars worth of value in the stock market, the bond market, and the equities market. And today, to have lost 45% or more of total net worth in the world is unprecedented, far surpassing anything that was lost in the 1930s. How bad is the present financial crisis? I think, frankly, on every investor's mind is, when will it end? And where are we going from here? I think to have a beat on where we're going from here, you have to understand where we are today, first and foremost. Deal with the truth and then make adjustments for it.
You're going to get so many mixed messages from Wall Street and the financial media, most of whom are trying to be optimistic and say this is not so bad, it's not going to last so long. And these are the same people that were telling you that there was going to be no recession, there was going to be no depression, there was going to be no downturn in the stock market. So now they're saying, well, okay, so there is a bit of a downturn, but it's short term. We
have the implosion of credit default derivatives, which has taken down or severely wounded many of America's largest firms, including the financial giants. And you have to assume that when we emerge on the other side, which I think we will, it's not going to look the same, it's not going to feel the same. Leverage acts as a multiplier for the profits of any company or any individual. Wall Street's been addicted to leverage for years, and they've increased it multiple times over the last decade, 2 decades, to the point where Bear Stearns had 32 times leverage, the average bank had 25 times leverage, the Federal Reserve currently has 75 times leverage on their balance sheet. That's fine as long as things are going up, but when things go down, then leverage and what benefit it gave to profits, now it takes away in spades. The average bank in America coming into this crisis was leveraged 25 to 1 and is now scaling back to a more reasonable 10 or 12 to 1 leverage. That's still a lot of leverage. That's still a lot of leverage, but it's half the leverage they had. And I think you can assume that the earnings of the powerhouse banks are going to be diminished significantly because they're not operating on the same basis they were before. You look around and it seems to be business as usual. The world's financial institutions continue to operate. What's changed is they've gone from being the most powerful institutions in the world to being pariahs. Their balance sheets are gutted. They're technically insolvent.
It's not just the little guys that are getting hurt, it's the biggest guys in the world. And they're, of course, the ones who help create the problem, and they're the ones that are getting the big bailouts. So life is not always quite as just and fair as a lot of us would like it to be.
The bailout of 7 to 9 million U.S. homeowners will not stop the real estate collapse.
25 largest U.S. metro areas, prices of homes dropped over 22% in 1 year.
8.3 million U.S. mortgages were underwater as of December 2008.
For 6 quarters in a row, U.S. household net worth has dropped a total of 20%. Fourth quarter of 2008, 9%, 1 quarter.
U.S. residential foreclosures were up 30% in February of 2009.
5.4 million U.S. homeowners, or 12% of the total, are now either delinquent or in foreclosure.
Homeowners in California lost $1.2 trillion in home values in 2008.
The sharpest drop in U.S. real estate history. In a 3-month period, over 18.2% in the fourth quarter of 2008.
We have American homeowners. They're getting killed. In many parts of the United States, real estate is now down 40, 50%. In some places like Florida, California, in the year of 2008, saw housing prices drop $1.2 trillion. That's just in one state.
American homeowners, investors, retirees, they've been decimated. How? They've been decimated because you've had real estate values and stock values implode at the same time.
You have a massive number of homeowners now, 8 to 9 million, that are upside down, meaning their mortgage is larger now than the equity that they have in their home. And many of those people are going to simply turn in the keys and walk away from their homes. You've seen retirees and people in the stock market lose 50, 60%, some 70% of their wealth in their 401ks and their retirement plans. And so the wealth that people have built up in a lifetime in the last 18 to 24 months has been totally wiped out. Absolutely incredible.
And that's really unprecedented because usually it's one asset class or the other. And if you're looking at the average balance sheet in America, which over the last year is down 20%, the average American has watched their net worth disappear by a minimum of 20%. And that's net of everything. That's cash, that's securities, that's real estate.
So we're seeing people all across the spectrum get wiped out, and it's not just in America. It's in England, it's in Europe, it's in Japan, it's in Asia, it's in South America. It's literally all over the world.
The American homeowner, investor, retiree, these are other categories of where pain will persist because you're looking at catastrophic loss. Loss in the value of your home, loss in the value of your 401k, a loss in the value of your equity account or bond account outside. And now we're seeing, as we roll over and watch the dollar roll over, we're seeing loss in the value of even your cash position. It doesn't matter what state you're in, it doesn't matter what country you're in, it doesn't matter what region of the world you're in, everyone is experiencing pain in this economic crisis.
So America is plunging, and the world is plunging, as we have said, into the worst depression since the 1930s, and indeed, maybe much worse.
We're already there. We would argue that we're already on the cusp or actually in a depression. But where you see that is with unemployment exploding. Unemployment is the Achilles heel, with official rates of over 8% in the United States and some estimates as high as 18%.
You can't trust the government numbers. When they were saying unemployment was 5%, the real world numbers we were seeing were closer to 10, 12, 13%. More recently, they've been saying unemployment is around 8%. Real world numbers are somewhere between 15 and 19%.
We're talking hundreds of thousands of jobs lost each month. Now we're in 2009. Now we're experiencing 600,000 to 700,000. So anywhere from a 30 to 50% gain from last year.
What does this mean? They're not going to go to Walmart and shop. They're not going to be going into more debt. They may not be able to pay their mortgage. And so just look at the snowball effect from all of these people who have seen their income now cut off completely.
The problem remains we're over indebted.
The ripple effect of this unemployment is absolutely unbelievable.
Our society is one of consumerism, and our consumerism is backed by debt. We don't buy things that we can afford. We spend too much with money we don't have. Now we're in a bind because we don't have the incomes to match what we've already owed out. And this is why the consumer capitulating in the last 24 months is absolutely critical. Without the consumer, consumerism goes away.
U.S. retailing is imploding. There have been estimates that in the year 2009 that there will be as many as 220,000 retail stores close in the United States.
Consumer buying and borrowing has supported over 73% of our economy. As the consumer is now capitulating, you can expect the economy to follow suit.
Retail sales are now the lowest in 30 years, and in fact they're saying maybe the lowest since the Great Depression.
Retail sales in the first quarter of 2009 were the worst since World War II.
Circuit City, bankrupt. Ann Taylor, Eddie Bauer, Talbot's, Lane Bryant in trouble. Pacific Sunwear closing all stores. Gap closing 85 stores. Urban's department stores out of business. Foot Locker, Levitt's Furniture, Pep Boys, Zales, Six Flags, JCPenney, Linens and Things out of business. Disney closing 98 stores. Blockbuster on the brink.